In this video, let's explore what is allowance for doubtful accounts and what are bad debt expenses. Before we start, subscribe to our channel not to miss our new videos.
Accounts receivable is the debt owed by customers as a result of credit sales. Essentially, after goods are sold or services are provided, cash is received at a later predetermined date. Customer owes payment to the seller.
When a business makes a sale on credit, the customer receives the goods or services immediately. But the seller only receives payment after a certain number of days. This delayed cash inflow needs to be properly accounted for.
When a sale is made on credit, the business records the receivable as an asset on the balance sheet. This is done by debiting accounts receivable and crediting sales revenue to reflect the right of the seller to collect the debt.
Sometimes, customers are unable to pay their debts due to financial difficulties such as bankruptcy or simply refusing to pay. This results in a loss for the seller, as no cash is received, even though goods were delivered or services were provided.
Uncollectible debts are a loss for the business because goods were sold but no payment was received. It is important to account for these losses by recognizing doubtful or bad debts in the financial records.
Accounts receivable become doubtful after a customer fails to pay within the expected time frame, and any efforts to collect the debt have failed. At this point, the debt is classified as doubtful, though there may still be some chance of recovery.
There are two main types of uncollectible accounts. Doubtful accounts are debts that have not been paid on time, but there's still a chance they might be recovered in the future. Bad debts, on the other hand, are accounts receivable that are unlikely to ever be collected. As mentioned, doubtful accounts are debts that have not been paid on time, but there's still a chance they might be recovered in the future. Allowance is made for these accounts, which means they are not written off, but allowance for potential losses is accounted for.
As mentioned, bad debts are accounts receivable that are unlikely to ever be collected. These debts must be written off completely, as there is no longer any expectation of payment.
To account for doubtful accounts, businesses set aside an allowance. This allowance is a buffer to cover potential losses from customers who may not pay their debts on time or at all. The first method for calculating the allowance for doubtful accounts is to evaluate each customer individually. If a customer's ability to pay is in doubt, an allowance is made for that specific debt.
When creating an allowance for doubtful accounts, you debit uncollectible accounts expenses, which is income statement account, and credit the allowance for uncollectible accounts, which is balance sheet asset part account. It is contrary account to accounts receivable. This entry ensures that the potential loss is reflected in the company's financial records.
The second method is to calculate an allowance based on a percentage of the total accounts receivable. This percentage is determined by historical data and reflects the likelihood of non-payment. There are two ways to do this. Apply same percentage on total accounts receivable balance. Alternatively, apply different percentage for different groups of accounts receivable, depending on their age. Percentage of allowance depends on historical data of non-recovery of accounts receivable.
For the purpose of allowance for doubtful accounts, same percentage of the total balance of accounts receivable can be calculated. As an example, this can be 2% of total accounts receivable balance.
When creating an allowance for doubtful accounts, you debit uncollectible accounts expenses and credit the allowance for uncollectible accounts. The amount of allowance is 2% of the total accounts receivable balance.
Alternatively, different percentage on separate groups of accounts receivable, based on age, is estimated. Receivables are often divided into different age groups, based on how long they've been outstanding. Older debts are more likely to become uncollectible, so higher percentages are applied to these older receivables.
In this slide, we're looking at how different percentages are applied to separate groups of accounts receivable based on the age of the debt. Accounts receivable are categorized into groups, depending on how long the customer has delayed payment. For example, in the table provided, the first group consists of debt that are less than 30 days old. The second group includes debts that are between 30 to 60 days old. And the process continues for older debts.
Different percentage will be applied to separate groups to account for uncollectible accounts allowance. Percentage will depend on historic data of non-payments and due payment term, i.e. number of days, within customer must pay.
In this example, for accounts receivable less than 30 days old, no allowance is done. For debts between 30 to 60 days, 2% allowance is applied. The amount is $125. For debts between 60 to 90 days, 15% allowance is applied. The amount is $537. And for debts over 90 days, 60% allowance is applied. The amount is $3,394. The total allowance for doubtful accounts in this example amounts to $4,056.
The journal entry involves debiting uncollectible accounts expenses and crediting the allowance for uncollectible accounts by the same amount.
Bad accounts receivable are bad debts when there is no chance to recover them. Such accounts receivable must be written off. If allowance was made, write-off is settled with allowance. If allowance was not made, direct write-off is accounted for.
When a specific bad debt is written off and an allowance was already made, the business settles the debt by debiting the allowance for uncollectible accounts and crediting accounts receivable. This reduces the receivable and the allowance.
If no allowance was made, the bad debt is written off directly by debiting uncollectible accounts expenses and crediting accounts receivable. This method immediately recognizes the loss in the business's financial records.
Sometimes, even after writing off a debt, a customer might pay their outstanding amount. If an allowance was made, the business reverses the allowance and records the cash receipt in the financial statements. The journal entry involves debiting the allowance for uncollectible accounts and crediting uncollectible accounts expenses. Then, cash is debited and accounts receivable is credited.
If no allowance was made and the debt was written off, the recovery is treated as revenue. In this case, cash is debited and uncollectible accounts revenue is credited to recognize the unexpected income. In conclusion, managing accounts receivable through allowances for doubtful accounts is critical for maintaining accurate financial statements. By predicting potential losses, businesses can better reflect their true financial position and be prepared for customer defaults.
Thank you for watching. Subscribe to our channel not to miss new videos.
Let us know what kind of videos you like more. Practical problems or theory explanation. Please leave your comment below the video.